YouTubers! Mike Martin's here, Mike Martin's channel. Canadian households are just 0.01 points from the mother of all debt records. Here we go. Canadian household finances took another hit last year. Statistics Canada StatsCan numbers show that the debt service ratio, DSR, is a multi-year high as Q4 of 2018. The amount of income spent maintaining debt is now at level not seen since 2007. The volume of debt has effectively wiped out the household benefit for low interest rates. So that's money that's accounted for. So TDS, total debt service ratio, basically there's free TDS calculators online you can go to, and you can take that TDS and understand how much you have of disposable income. Now, when you have less disposable income, it's not good, I think, economic-wise, because you're not buying that blender anymore. Mind you, everyone's been buying their blenders on credit cards, to be very honest with you. And that's what's happening right now. Disposable income brings down consumer spending. And when consumer confidence and consumer spending goes down, the economy goes along with it. Because we're not producing and we're not fabricating and exporting anymore. We're relying on our economies to be built or pegged on housing, student loans, and consumer debt. Debt service ratio. The debt service ratio, DSR, is a percent of disposable income used for loan payments. Disposable income is left over after the government and non-discretionary payments take their cut. The ratio is an easy concept to understand, but the meaning is often misunderstood. Often you hear that the high debt ratio is fine because the level of defaults are low. That's great for banks, but that misses the benefit to the economy. It's exactly what I said. And also, you're not 100% guaranteed at your place of employment anymore, right? Debt is how you buy something today without having to have the full value. Future economic activity is pulled forward in exchange for the payments plus interest. Higher DSR means more of your future income is spoken for. To pay for consumption today, every dollar a household is obligated to a payment is a dollar they can spend, save, or invest. Those dollars they can't spend mean they can't drive future economic growth. A slowing economy can lead to much more than a mess of a few over-leveraged defaults if effectively turns into everyone's problem, even if they have no debt. Canadian household DSR is 0.001 points below the record high. The DSR, or total debt service ratio, of households in Canada is just a hair under the record high. The DSR for all household debt reached 14.87 in Q4 of 2018, a 1.22% increase from the previous quarter. The ratio has climbed to 5.46% from a year before, and is just 0.1 points under the high hit in Q4 2007. Despite near record low interest rates, people are paying a lot towards interest. Canadian household debt service ratio, here it is. It's going up. Holy smokes. So they're forecasting it's going to be back to here. That's what they're showing. It's just a hair off. So here's the problem. You got a blended interest rate because you're playing your credit card, your Visa, your MasterCard, your American Express, your Capital One, what's in your wallet. Then you're paying your if you got auto loans, this, that. What are you left with? That's a tough question. Oh, you make $150K a year. God bless America. Half of Canadian household debt payments go to interest. The DSR of interest only on these payments represent almost half of the interest-only portion of the DSR hit 7.34% of income. The Q4 in 2018 up 1.94% from the month before. The ratio climbed a massive 8.9% from last year, and now represents 49.36% of total in payments. Debt may be cheap, but households are making it up in volume. Mortgage debt is only part of the problem. Most might assume that it is related to steep home prices, but less than half of payments are mortgages. The mortgage portion of the DSR is 6.69% in Q4 of 2018, up 0.75% from the quarter before. The ratio is 3.56% from the year before, and is less than half the income spent on debt servicing. Even so, the payment spent on mortgage debt is the highest level since Q4 of 1992. Here's the percentage of disposable household income required for obligated mortgage debt and service payments. Wow. But it is going up too. Nobody panic here, because from 2002, 2003, it is going up. Over half of mortgage payments are going to interest. Remember, they front load a lot of these mortgages. I think Better Dwelling should explain how mortgages are front loaded and then why banks only do a 5-year term, not a 10-year term or a 12-year term, a 5-year term with a 30-year amortization. So that way, or a 25-year amortization. So this way they could front load your mortgage again when you re-sign for a better rate or a better deal. We know it's the good debt though, right? Not exactly, when over half of the payments are currently going to interest and the DSR for the interest portion of mortgage payment reached 3.72% in Q4 in 2018, up 1.9% from the quarter before. That's a 7.5% increase compared to the same quarter of a year before and represent 55.6% of mortgage payments. Yes, the typical Canadian pays their banks more than they're putting towards principal. Of course, Canadian mortgage DSR interest only. So that's going up. So people think times are going to get good again and they're going to be making more money and they're going to get an increase in pay. And I covered last night job losses across Canada. Canadian households are making near record high debit service payments that would be surprising if interest rates weren't near historic lows. The sheer size of debt accumulated from low rates created a massive debt trap. Despite the cheap money, monthly payments are still almost half the interest. The benefit of cheap money has been nearly neutralized. Most likely this will turn into extended period of low income growth. So that's from Better Dwelling. Let me know what you guys think in the comments below. Guys, if you want to, I took down my tip jar. So if you guys want to support the transmission, please share one of my videos, get it out there. I've been forecasting this for many years. I'm not post-dicting anything. I'm just telling you. I'm going to find an old TDS video I put up explaining TDS and how the TDS works. We did several videos, actually, the last 5 years talking about total debt service ratio. And watch out for the boogeyman when you're only paying a front-loaded mortgage. Let me know what you guys think. Comment below, and thanks for watching.